Okay, so the first question that I have for you guys as panelists is, why does it even matter what the correlation of venture returns is with returns of other asset classes?
Well, I'm happy to take a crack at that and let Alan and Pat correct me, but I think it just gets to the beauty of diversification. If you look at venture, and specifically early stage venture, you see the highest return over a long period of time, but it's not liquid, and the investment returns are really variable. But the returns are not well correlated with public equity returns because, in venture, you invest today and you have to wait a few years before you get your return, by which time where the market was today is a distant memory. And so you end up with a kind of time shift and when you get the high returns and when you get the low returns. And that means that the returns go up and down at different times in venture than they do in other investments that you make, like public stocks. And what that means is that even though venture is variable, because it goes up and down at different times, it can actually decrease the volatility in your overall portfolio. And that's what it means to have imperfect correlation. And people used to think that they would benefit from that lack of correlation if they invested a little bit in public stocks and a little bit in fixed income. But in the last couple of crises, we've had, stock markets and bond markets tank at the same time. And so people have lost some of that benefit to diversification, and having a small amount of one's wealth in venture, I think, brings that benefit back a little bit.
Awesome. Thank you so much. That was definitely an articulate response. Alan, do you have anything to add to Eric's response?
I would say we live in a changing world, and in this world today, the economies are both good and bad, but innovation will cover both of those, both the good and bad economy. The venture funds are always looking for the problems that exist out there and delivering a solution to those problems in the business world. So right now, a big thing that's happening is this emerging industry of AI. I just got off the call with AI and a company getting ready to launch, and it's a very, very hot topic, yet it's a frontier. And just adding what Eric said, even the best in the venture industry only get it right 1 out of 7 times. It's kind of like drilling for oil, though, but that one investment will pay everything else off. So you really, on a long-term horizon, it's best to invest into a fund rather than individually so that you can play the odds of making sure you get a good return on investment, covering your risk over many companies.
And I would just add to that we kind of need to bifurcate venture into 2 categories, early stage and late stage. Eric's always been touting that they actually should be 2 different asset classes if you really consider it. And the benefit to the early stages, because you're playing the longer game of 8 to 10 to 12 years, perhaps, you get it at such a valuation that even if the macro environment gets really choppy, it doesn't affect your investment as much as if you got in at the late stage and the valuation you invested in was at 500 million, and then you see that cut in half, right? And so, because even though that would still be a bummer for people who invested, early stage, we still have a decent multiple that we could rely on at that point, but we also know it's going to recover. So the benefits definitely lie, even though you have to have more patience in the early stage game in venture capital. And you have to be extremely good at late stage venture if you're going to play that game.
Awesome. Thank you so much. And, back to the point of what Eric was talking about throughout his presentation, he talked about the year after the crisis. So why is the year after the crisis a good time to invest? Eric, I'll let you take that one.
Sure. Well, it's because a crisis brings down valuations, and it tends to bring down valuations everywhere. In publicly traded stocks and privately traded stocks, and that makes the entry point cheaper. A lot of people find it intuitive that if the S&P goes down, that's a good time to buy the S&P, but they find it less intuitive that if private company valuations go down, well, that's a good time to buy private companies. And the real point is that by the time those companies mature, which is a point Pat was making, that crisis is in the past. We went back and looked at the data. I used to be an academic, so I like to crunch numbers as a strange hobby. We saw a batch of strong startups after each crisis, back in 1987, back in the tech bubble burst of 2001, and in the global financial crisis of 2008. So if you look at some of the startups that received funding at really depressed valuations in 2008, 2009, some of those names are Uber, Airbnb, Square, WhatsApp, Groupon, Glassdoor. Those all got started in the year after the global financial crisis at really low valuations. And by the time they were mature, the global financial crisis was a distant memory. And that's the dynamic that leads to the data that show that it's a year after a crisis. It's not a guarantee, but on average, those tend to be better vintage years for having deployed into venture.
I would say that on the opposite side of the table, from the startup side, the quality is better, right? So because capital is no longer free, right? We had to stretch from 2009 to 2021 where capital was free. It was very easy for companies to experiment and to, break things and run fast. And there was less pressure for them to get to profitability, right? Their survival really wasn't at stake. But in these types of environments, companies really have to be fit, and they have to be fit early. And it's a matter of survival for them. So because they know they can't keep raising round after round, they have to get to cash flow positive and profitability as soon as possible. The other side is, it's easier to hire and retain world-class talent as that startup because there aren't as many options out there for them. So you're looking at really quality talents sticking around to see a vision through with a mission that they have to build something special and they have to get to profitability very quickly.
That's great. Alan, how about you? What do you have to say about this?
I just like to add into it that the rule of thumb, you never chase a stock or you never chase the stock market when corrections are done. You try to understand where the problems rest, and it's always what they're out to resolve. And I just like to add in here that one of the problems that exists today, if you look into the markets, companies, COVID had an effect on really what used to be a sound business model where people would commute into the cities and go to work. COVID changed all that. All of a sudden now you have, I'm just going to work from home. I got my remote commute and using my computer, I can connect on Teams. So all that technology has changed. Where people are resting right now is when companies are trying to scale, they're now realizing that they're not finding the labor out there. It used to be that they would scale on more people, using that as the metrics. Now they're scaling on technology. Baby boomers exiting the workforce out number the people coming in by 3-1. And so AI has to be in place. And so really where the companies are trying to solve is, how do I become more efficient in using technology? And in the efficiency there was a number that was given to me in the AI, the Chat GPT model. Okay, this is one of the things that needs to be solved. But they say that for every calculation in AI with Chat GPT, to do one calculation, it takes 16 ounces to cool the computer units. So when you think about the billions and billions and billions of calculations and the water that is unsustainable, and also the chip backlog that NVIDIA, these others have. So this is a market right now that this sector is going through a paradigm shift and transforming. And I think when they come out the other side, the companies that win at that are going to be revolutionary and transforming industries. But right now, if you try to look at the past, you're not going to be able to predict what's happening in the future. And that's why venture capital is so important, because they're working at solving the problems of the future.
I love that. Thank you so much, Alan, for sharing that. Venture is very important to the future. Now, what we're going to do is, Alan made a good point in talking about AI and solving the problem. And so this next segment, we're going to roll right into the second segment here. And this next segment is going to be talking about investing into AI. What do you have to say in regards to this topic, Eric?
I go back to the analogy of the internet, where the internet first meant investing in obscure startups that no one had ever heard of. And then it was a real differentiator in whether you were going to invest in Ford versus GM, or, Kellogg's cereal versus another cereal maker. And we see the transition over the last 3 years. AI has become just like that. It's gone from investing in obscure startups that no one's heard of to how do businesses that you're very familiar with, who's using AI as a productivity tool better, and how does that handicap the relative performance of different really established companies. And I said that we're seeing startups taking existing tools and using them to improve productivity. 2 quick examples. One of our companies took machine learning tools from one realm and applied it in digital medicine to make synthetic medical records, which would allow medical and pharmaceutical research to access large swaths of personal medical histories without violating any one person's privacy or the HIPAA rules. And that could really accelerate drug trials. Existing tool used in a completely new space. We have another portfolio company called CrowdSmart that has tools that distill group opinion and group consensus to mitigate individual biases in decision-making. And they found an early use case in improving marketing analytics to dramatically increase the return on investment in the marketing spend for companies using the tool, whether those companies are big or small. So we're just seeing this explosion of AI tools developed in one domain being applied to a new domain, and that's creating whole new business models for investing.
Thank you, Eric. Alan, I know this is a big topic for you, AI, ChatGPT, and this whole realm and where we're going into the future. What do you have to say in regards to this topic?
Understanding some of the challenges that exist in AI, there's a lot of money, as Eric had shown on the slide, drifting towards that direction. A lot of people that are working in this new realm of AI, that these companies are still remaining unfunded as they go through and explore. Probably one of the biggest challenges that's out there right now is failing to produce the lab results from the academia into the real world. I'm sure that people that have used ChatGPT and gone through models have asked questions, and ChatGPT has come back with the response, and the individual knows, well, that's not a true response, to which ChatGPT apologizes. Yes, I'm sorry, that's not a true response. So learning how to use this, it's still kind of the wild, wild west, and there's a struggle to scale AI systems in most use cases. And so we'll get there, but just because a company says, I'm using AI, doesn't mean that we should jump in and do this. It's really the AI that matters here is where it can be used to solve the true challenges that we face in the real world and the application of those challenges. And I think one of the things that we have a challenge with right now is that of the computing power. When you think about all the people that are on ChatGPT, they're all using it. They're all doing the same thing, and it's coming up with answers. But how do you scale that in the business world? And how do you make sure that as you move down a direction that's really going to truly solve a real world problem that cannot be solved otherwise?
Awesome. Pat, do you have anything to add to that?
Yeah. So I'm proud to announce that Impact Venture Capital has been actively investing in AI since 2016, before the bells and whistles started popping off everywhere in the past couple months. So we've been doing this longer than most people. But yeah, AI is so disruptive that it's actually disrupting itself. So one of our venture advisors, Cody Walcott, was with Intel for years and years, and it's working on artificial intelligence in the future. Now she's working on something else. But to Alan's point, why you're starting to see these diminishing, let's call them diminishing returns in the accuracy of the results is because these models go out and they scrape the web very quickly. And as we know, if it's on the internet, it's got to be factual, right? But the problem is what it does is it scrapes the internet with the best knowledge out there. And then it creates its own database. So it can then reference that information for future queries faster than it could just by scraping the internet. The problem is the database it's creating is filled with inaccuracies. So now you're getting quicker results, but with more inaccurate, responses. So something they're definitely working on, they will figure it out, but it's going so fast that it changes every day. So there's going to be some guardrails and new innovations put up that will help solve these problems, but it's important to keep that in mind. And one other point is there were, after ChatGPT and OpenAI became a thing, I think in 1 month there were 600 new AI companies, but there were actually only 300 plus really companies out there. So what they did was very similar. They know what investors are looking for. It's the same thing when blockchain became popular. Everybody all of a sudden threw on a blockchain extension in their pitch deck, and their valuations that automatically popped up. So people are now saying, oh, yes, and of course we're incorporating AI into our company, when they may not be, or they're just licensing a bot so they can claim that they're actually an AI company or have an AI play. So it's very important to be able to distill that conversation with the startups and understand, is this a genuine company really leveraging artificial intelligence in a meaningful way, or are they just, putting on a nice coat of paint, hoping to get some funding for people looking for companies playing in the AI space?
Thank you so much, Pat. Again, to the point that Alan makes, as we transition into this new era, or, the new dawn, so to speak, we'll definitely feel like the wild, wild west as we enter into this new frontier of AI, ChatGPT, and how it's going to affect, the economy, how it's going to affect the world and the people in it, right? So how do you think that ChatGPT and AI affect employment, and how will it affect the economy itself?
Well, that's a really big question. And I think we probably can't do more than scratch the surface, but let me at least do that. We're seeing ChatGPT and other tools automate what used to be the core domain of humans. I mean, look, we used to say, well, technology can do physical labor, but it'll never replace artists and creators. Well, it turns out it will. AI can write a movie and star in it. I've seen a Star Wars clip from a Star Wars sequel written and acted by AI that looks completely real. It can create art. Software developers can write software that writes its own software and improves itself. And the upshot is that this industrial revolution is different. A couple of decades we built robots that could build cars more efficiently than humans on the assembly line, and then fewer jobs were needed. More recently, we had self-driving cars that can replace taxi drivers or truck drivers, and fewer of those jobs are needed. But now AI is coming for your job. Now AI is replacing white-collar jobs. There's a venture firm in San Diego where the algorithm picks the startup investment. So even my job is now threatened by AI. And jobs are certainly at risk. But at the same time, there's a productivity gain. The most easily replaced elements of jobs are the parts that are being automated. A journalist can assemble facts and then ask ChatGPT to use those facts to write a first draft in the style of that journalist. and instantly create a first draft of their article. Now that could replace the journalist potentially, but it could also free up the journalist to spend more time gathering the facts, more time on the investigation, and less time on writing up. Maybe they could write more articles. There can really be unprecedented productivity gains as AI automates the clerical part of every job and lets the worker focus more on the strategic element. So in the end, it's another productivity tool. We had the printing press replace the scribe. We've had the car replace the horse, and the robot replace the auto worker. And now it's happening to white-collar workers, which is the people who make policy, the people who donate to politicians. And so it's going to be interesting to see how it plays out. The overall impact on productivity will likely be high, but the disruption to jobs will be really interesting because it can now replace all of our jobs and not just some of the less educated ones.
Well, maybe we can get AI to support and sponsor the politicians as well. So let's figure that one out.
Well, I don't know. Maybe it couldn't do any worse.
Awesome, Alan. What do you have to say about that?
I laugh at that last comment because actually I know an individual that he's one of the pioneers in AI through using it by predicting emotional intelligence, and that's one of the things that he uses to predict elections. It also use it in the space of HR, human resources, and how AI should best be used. Incidentally, he sold the company for like $11.9 billion. So I don't think he has to go back to work again. But I think again that where we are with this is I have mentioned about the probabilistic computing and decisions trees and being able to do an audit trail for how AI comes up with the answers, being able to run it backwards. I feel that as we venture deeper into this, it's important that AI be used in a probabilistic way that will deliver solutions that we really need for the real world. I had a friend that used AI, started a company, and he found 23 ways to cure strains of cancer by modifying DNA cells. Those types of things will benefit humanity as a whole, and I think we're just getting started in on this whole thing. But if you're looking at venturing into AI, it's just not seeing the words artificial intelligence, it's understanding what problem are they out to solve, and do they have the capability and the competencies within the organization to fulfill, what their mission is.
Awesome. Thank you so much, Alan. Pat?
So I'm a big fan of the human spirit and our ability to be able to observe and adjust on the fly. So I think I have a less dystopian and doom and gloom vision of what this is going to do. I think the jobs that are most at stake are the people who don't learn to use AI to their advantage and their company's advantage. I think it will get them 70 to 80% there, getting rid of a lot of the legwork and allow them to polish it up and make the adjustments and free up, again, 70% of that time that they can use being more productive in other avenues for that employer. So I think it's going to be a tool and not something that steamrolls people's jobs unless you don't learn to leverage it and use it. Same thing was, true with internet and mobile. People resisted. And eventually those people that didn't adapt and learn to find its qualities and learn to leverage it and expand upon it, they had a harder time. I think AI is going to be a very a tool that is just helps productivity, will get you 80% there and allow you to make the product even better and be more productive for the company. But I don't think, unless you don't learn to use it, I don't think it's going to be the job stealer that a lot of people think it's going to be.
Yeah, definitely the time to really lean in and adapt, to your point, Pat, not to shy away or run away or kind of put the blinders on and act like this isn't going to happen. This is going to happen, and it's time to lean in and adapt with it.